Okay, so before I get started, a little bit about Mintz. We're a global law firm. We focus on emerging growth companies. We help companies raise money. We help them get sold. We help them go public. We actually have a website that is focused exclusively on working with early stage startups. It's called mintzedge.com. I urge you to go check it out. Lots of free information there. We have checklists, we have articles, we have videos, we have podcasts, and they're all focused on how do you take your business from startup to build a team, to get funded, to get to the end game, the ultimate exit, whether it's an M&A or an IPO. We have some materials in the back of the room where you checked in. We also have these little things we call Mintz, which is our little catchphrase. They're delicious. I promise you'll love them. There's one for everybody at the back of the room. Grab them, take them home, give them out to your friends, your wives, your kids, your spouses. They'll love it. Okay, so enough with the commercial. What's happening in venture capital? As you can see, number of deals, this is number of VC deals done in the United States, pretty flat, maybe a little bit trending down in 2019, but the numbers, a pretty good number, pretty flat, so there's been a good activity. It's a good time to be an entrepreneur. It's a good time to raise venture money. What's interesting is the dollar amounts. Even though the number of deals have been relatively flat, dollar amount has gone up pretty dramatically. Anybody guess why? The funds are bigger. Thank you very much. The funds are much bigger, which means they have to put way more capital to work. So it's an interesting time to be an entrepreneur, right? It's kind of easier to raise $1 billion than to raise $1 million. The early stage money's really dried up. VCs have moved upstream. They want to fund it later. They want to do bigger rounds. So we're seeing a lot more money going into the space, but it's a lot harder to find the early stage money. So let's look at strategics. They've actually gotten a lot more active in the marketplace. Now you see the number of deals, they don't do as many deals as venture capitalists, but they're pretty active. And if you look at, again, a little bit of a trending down over the last year, but not dramatically so. But here's the most interesting one. Look at the dollar volume difference. Look how much more money strategics are putting into companies than the VCs. It's literally, a factor of like 7, 8, 9. So you're here today, you're talking about working with potential strategic partners, companies like SAP. They're very active. There's definitely more money being put in by strategics than I've ever seen in my 30-plus year career working with emerging companies and venture capital-backed companies. So we're going to talk a little bit about the benefits of working with a VC versus working with a strategic investor in a second. So I've put together this funding timeline that I use with all my clients. I highly recommend you take a look at this. I'm happy to send slides to anybody. Please send me an email. I've got cards. I'll send you these slides. The key thing on this funding timeline I want you to focus on is preparation. Probably the biggest mistake that startups make is they go into the funding and they aren't really prepared. Their company's not set up right. They're not properly capitalized. They haven't documented things. And they create friction where the venture capitalist has a reason to stop and say, no, I'm not going to invest. There's just too much mess here. And that's such a terrible waste of your opportunity because you can fix those things by getting on it quickly and early on before you go out to go raise money. So plan, clean up your company, get your IP protected, make sure your capitalization is right, talk to an experienced early stage, hopefully lawyer who knows the space, who can make sure that you are ready to be out talking to investors before you do. Okay, what do you need when you go out to those investors? You all probably know this, right? The exec summary pitch deck. That's really all you need. You don't need the 500-page business plan. You might need that for your own internal purposes, for growing your business, but do not send that to investors. All you need to do is get a really good, pithy 1 or 2 page exec summary, maybe a 10-page pitch deck. We have a lot of good materials, again, on mintzedge.com, where you can go and see what those pitch deck and what the exec summary should have in it, what they should say. And in fact, if you want to connect with me on LinkedIn or on Twitter, I'm on Twitter as well, I have linked to my accounts an article that I've written that tells you from 30-plus years of experience working with literally hundreds of venture capitalists and, gosh, probably 1,000 startups, maybe more, what they look for in that exec summary. And so you know how to write it. It's kind of step-by-step, tells you how to write it, how to attract their attention, so it doesn't end up in the round file. Okay, so I've got a question. Your exec summary and your pitch deck, right? You write that because you want them to invest in you, right? That's how you're going to get them to invest, right? Quiet audience here today. Kind of, sort of, right? But that's not really right, right? And this is where people kind of lose focus on what that executive summary and pitch deck have to do. There's really only one purpose for you writing that executive summary or pitch deck. Get a meeting. Get a meeting. That's all it is. They're not going to invest based on your executive summary or your pitch deck. That pitch deck and that exec summary is going to get you in the door to get a meeting. It's the meeting that then leads to the next meeting, and then hopefully a presentation to their full partnership, and then they're going to write the check to you. So people kind of, and the reason I share that with you is a lot of entrepreneurs, you all love your technology, you love your idea, you love your business. So you get so detailed explaining all the details of like how it works and why it's better, and that's great, and you need to do that, but not in the exec summary and in that pitch deck. It's just trying to get a meeting. You're going to have that opportunity when you get the meeting. So don't overdo it, stay higher level, and write it to the audience, okay? And that's the key thing I think you'll see if you look at some of the articles that we've published on our site. And then the rest of it's kind of getting through the process, the closing. We're going to skip through that right now. Okay, so why do you want venture capital? Lots of reasons, right? Money, of course. Money now, but more importantly, money later. The great thing about having a VC fund versus having angels is the VCs, they put money aside. When they write that check for $5 million, they put $10 million more aside to fund you in later rounds. So you've got money available to grow your business. Look, you got to go to angels, especially in this day and age, because the venture markets have changed and there's not a lot of early stage money. But the reality is, very few angels have the backup money to come in for round 2 and round 3. So at some point, you're going to need to get to VCs, and it's all about getting the current money and the future money. If you're lucky, you'll get someone who knows your industry. They'll bring a lot of expertise, but you got to pay attention to who's actually going to be involved in your business, who the board member is that they're going to put on your board. A lot of VCs can bring you industry contacts, customers, and of course, we all know if you have a venture capitalist, especially a big name venture capitalist, all of a sudden, you know, you're very attractive to customers, to other future investors, et cetera. It can be very advantageous. There's some downsides. And if anybody's been reading the newspaper lately, just reading about, you know, WeWork, right? You can see what happens sometimes to founders, right? Thank you very much, goodbye, right? That happens, and that's the reality. When you take the money, there's the distinct possibility that if you're not doing your job, they can take you out. So you have to understand that, and if you're not willing to have that kind of loss of control, don't even bother going to talk to VCs, because they will not invest unless they have the ability to take you out if you're not doing your job. So do your job. Grow the company, right? Under-promise, right? Over-deliver, right? Don't tell them you're going to do 10 million in revenue next year and you're only going to do 1, right? That doesn't help anybody. All that does is get you booted out faster, right? So you got to manage the VCs and manage the board, and that's a lot of what I advise companies about, is how to manage VCs and manage the board. You know, they'll want you to grow faster. They're going to be pushing to an exit. That can have pluses and minuses, and then of course the scrutiny. So let's jump to strategics again, because it's kind of been an interesting time. I've been seeing a lot more strategic investors playing in the early stage space, and I think it's a great opportunity. Strategics are usually, though, not willing to lead, and that's been changing. I would say probably 5 or 8 years ago, I would tell you I almost never saw a strategic lead around and set evaluation. That's just not true anymore. I'm doing a deal right now with a large strategic investor where they are the sole investor. They're setting the valuation, they're leading the round, and of course there's a related commercial agreement, which is one of the interesting parts of working with strategics. That commercial agreement is really the reason that they're investing, and we'll talk in a second about some of the risks of that. Again, you know, there's not as much control. They typically don't want a board seat. They're typically just looking for what we call observer rights, which means they attend board meetings, but they're not necessarily going to be looking to be in control and boot you out the door if things don't work out well. A little bit of a different approval process. I'm not going to get into that. Not all that interesting for you guys. Plus, we have a short time. Here's what's the really interesting part. When you deal with strategics, it's really not just about the investment. They have a commercial agreement, they're interested in your product, and what they're really interested in usually is buying you. So that sounds great, and you think, isn't this great? I get money, I get a commercial agreement, I have the buyer right there, my natural buyer, isn't that fabulous? Well, it can be. But if they're interested in buying you, there's a bit of a conflict of interest, right, if you think about it. Do they want you to grow really fast? Do they want your valuation to go from $1 million to 10 million to 100 million to $1 billion in 4 or 5 years? Well, they make money on their investment, but gosh, now they've got to pay a lot more to buy you. And I can tell you from having done a lot of these strategic deals, that conflict of interest makes these deals very, very complicated. To try to align the incentives, to try to make sure that the strategic isn't going to kind of hold you back for their own benefit. So again, it doesn't mean you don't do deals with strategics. Again, this sounds like a bit of an advertisement for lawyers, and it probably is. But if you're going to take money from a strategic, man, you better work with somebody who's done a lot of those transactions and can help you make sure that the incentives are aligned. And I can tell you lots of horror stories. I could bring up a whole bunch of CEOs who've done these transactions and ended up in a terrible situation where their company was sold for much less than it could have been sold for because of some of the maneuvering that was done by the strategics to kind of slow them down, avoid competition, slow down growth. One of the hardest things is, I've been seeing this more and more, we see it mostly in the life sciences space, but I'm seeing it now outside of the life sciences space, and that's what this option to acquire. So basically, at the start of the investment, they have an option to acquire you, and that is usually based upon some formula, a valuation formula. Think about that for a second. If I have an option to buy you, when am I going to exercise that option? I have an option to buy your company at $10 million. Am I going to exercise it when your company is worth 5? No. Am I going to exercise it when your company is worth 20? Yeah, but I'm paying 10. So is that option really good for you? No. Because if your company is worth 5, you think they're going to exercise the option for 10? No. They're going to come back in and go, we have the option at 10, but your company's worth 5, we're paying 5. It's not really advantageous, and yet a lot of these strategic investors insist on it. I urge people, resist as much as you can, but sometimes you got to do what you got to do to get the money, right? So real quick, advantages of strategic investors, definitely less valuation sensitive. You might be able to get a better valuation than from a VC. You do get the benefits of the related commercial agreement, so there's some revenue, there's some product that is now being validated. You get certainly industry expertise and a potential buyer, not bad. We talked a little bit about some of the disadvantages, the mixed incentives, the conflicts, which are even the most interesting. There can be board conflicts, which we could get into in more detail. And as you can imagine, just approval rights, and what happens if another competitor wants to come in and do a transaction with you, and can they block it? Do they have to approve it? Do they get information about it? You can just imagine all the complexity that happens when you bring a strategic in. So anyway, a bit about my bio, a little bit more about Mintz Edge. I want to make sure you guys are aware of that. Really a great resource. I urge you to go to it. It's free. A lot of good information. You can email us as well and ask any questions. And I want to save a little bit of time for Q&A, so we have like a minute. How was that?